Good afternoon. I'm Robert Mays with BlueCreek Investment Partners. Well, the market rallied last week as the S&P 500 rose 3.1% by the close on Friday. Now, this rally essentially has retraced just about all of the loss that had occurred since the high point in mid-January. Now, this is on the back of three reports that came out last week. One report being on manufacturing, that we saw continued growth in the manufacturing sector, which shows the need for businesses to start replenishing inventories, lots of new orders starting to come in. And then we also saw an expansion of the service sector industry. Now, this one is particularly surprising to me because February was such a dismal month with so many winter storms that blew through to really create a lot of disruption in that particular sector, and yet it was able to come out of that and still show an expansion. The third thing that we saw on Friday happens to be the job loss number, where it was reported that we lost 36,000 jobs in the month of February. Now, it was anticipated that we were going to lose 65,000 jobs. Now, again, in light of the weather conditions that we had in the month of February, it's our view that very likely in March or even April that we should start to see job gains. That being that this number was so low in February, and given the weather conditions, that in fact that very easily could have turned around and been a flat number. Going forward, we're about to finish I think there are only 25 companies left that haven't reported in the S&P 500 for earnings. And of those that have, 75% of those have managed to beat the street estimates for their fourth quarter earnings season. Our view is that this is, again, just a repetition of what we experienced for the third quarter as well as for the second quarter of last year. And we think that the first quarter of this year is also going to be, again, a repeat of that process as we get into earnings season going into April. I also believe that the first quarter GDP number is going to be stronger than what many analysts expect. And again, that's based on 4 points, that a couple of which I've already mentioned today. That being the expansion of the manufacturing sector as well as the service sector. The third being the number of hours that each employee is working is increasing. Productivity is increasing per worker. And then, of course, the fourth item of that happens to be the number of temporary hires continues to grow. And so as we start to see these numbers pick up, and the fact that earnings have come out better than what many people had expected, as well as the guidance starting to be a little bit more optimistic going forward. All these things seem to be setting up for us to have a good first quarter of this year, strong GDP number, as well as earnings going into the next season. So our view is that the market rally that we're seeing here is justified as it starts to look forward and discount some of this good news that the economy, in fact, is picking up some momentum here. So that's it for today. I hope you have a good week and look forward to talking to you again next Monday. Bye.